Every dollar you spend on rent this month is equity that you'll never get back. But with high mortgage rates and high prices, affordability is close to an all-time high. That's the 2025 housing dilemma in a nutshell. And in this video, you're going to learn exactly how to think about it so you have clarity and confidence in your plan. Let's start by looking at the current state of the rental market. The good news is nationwide rents have started to flatten out. As of September 2025, the typical asking rent is holding steady at about $2,000 a month. That's just over 2% higher than last year. That's a positive for you as a renter, but the problem is that you're probably already spending more than 30% of your income on housing. Now let's take a quick look at the current state of the purchase market. Home prices are also flattening out, but remain high because there are less homes for sale and we're not building enough homes to keep pace with demand. Home values are expected to rise another 2.5% this year. So, renting and buying are both expensive, but which one is more expensive over time? A typical rent increase of 3% a year doesn't seem like that much by itself, but it turns a $2,000 rent payment into over $2,687 in 10 years. And in addition to rising costs, rent carries other risks. As a tenant, you have less control and stability. Your landlord can sell the property or decide not to renew your lease at all, causing you to have to move when you don't want to. And as a renter, you also miss out on the appreciation. A $350,000 home that appreciates by 4% grows by $14,000 each year in value. That's $14,000 of wealth you miss out on while renting. And over 5 years, with compounding, that's over $75,000 that your landlord gained in equity instead of you. But what about the high mortgage rates? So let's put mortgage rates in historical context. 6.5% may seem high to us, but historically it's not that unusual. In fact, the long-term average mortgage rate since the 1970s is about 7.5%. We're just not used to it because we came off of an era of artificially cheap money. But the thing to keep in mind is that if rates go up, your rate is locked in and the bank can't raise it. But if rates go down, you have the ability to refinance into a lower rate. So a fixed mortgage gives you interest rate upside without the downside. So how do you use this information to make a decision? A good place to start is to think about your break-even point. Your break-even point is when owning starts to become more advantageous to renting. Right now, in most parts of the US, that's between 5 and 7 years, depending on how high your local prices are relative to your rents and how high your closing costs are. Once you stay in the home for longer than that, the advantages of buying start to compound in your favor as you build equity by paying down your principal while letting price appreciation work in your favor. Your mortgage payment also stays the same while rents around you rise. On the other hand, renting makes sense if you expect to move before your break-even point. So next, let's cover ways to make coming up with your down payment a little bit easier. If you're worried about having enough money for your down payment, here's some good news. You don't need the typical 20% down. You can put down as little as 3% through conventional loans or 3.5% with FHA loans. And there are many programs that you can tap into for down payment assistance as well. I also would tell you to be careful of trying to time the market or waiting for prices to drop. It's very difficult to time the market, and it doesn't help you if prices rise another 15% before they go down 10%. And while you're waiting, you're continuing to pay rent, and just as prices can go down, they can also continue to go up. The smart move is not to try to time the market, but to hold long enough to let appreciation do the work. Holding long enough is the key to unlocking the true power of homeownership, which brings us to the big picture. The power of homeownership is how it builds wealth. According to the Federal Reserve, the typical homeowner's net worth is roughly 40 times higher than the median renters. So in other words, by buying instead of renting over the long term, on average, you'll grow your wealth by 40x. And that's not just from appreciation and paying down your principal, it's also from leverage. If you put down 10% and your home appreciates by 10%, you have a cash-on-cash return of 100%. You doubled your money. At an average appreciation rate of 4% a year, that'll take just 2.5 years. And the financial benefits don't stop there. There are also tax advantages where you can use your mortgage interest and property taxes to reduce your taxable income. So when you factor in appreciation, principal pay down, and tax benefits, homeownership becomes one of the most powerful wealth engines available if you will remain in the house long enough to let the growth compounding work in your favor. So here's the big picture. Affordability is difficult right now in both the rental and purchase markets. Mortgage rates appear high compared to recent times, but they're actually historically typical. A better question than, is it a good time to buy, is, can I stay long enough for home ownership to beat renting? And for most people, that's about 5 to 7 years. If you stay beyond that, homeownership almost always wins. So if you're a first-time home buyer debating whether to rent another year or finally make a move, speak to a mortgage lender to see what you can afford. Think about how long you expect to remain in the house and explore incentive programs available for you. If you found this video helpful, subscribe for more first-time home buyer videos like this one, and feel free to contact me if you have any questions about buying your first home. My contact information is in the description below. Thanks for watching, and I'll see you in the next one.